Hi everyone, Jim Wang here from bargaineering.com, and I'm here on the TurboTax Blog to talk to you about the differences between a traditional and a Roth IRA. The big difference between these two retirement accounts is that the traditional IRA offers you tax-deferred investment, while the Roth IRA gives you tax-free investment. What happens is with the traditional IRA, the contributions that you make, you're able to deduct on your tax return so that you don't pay income taxes on those dollars. Conversely, the Roth IRA, the contributions are not tax deductible, and so you pay taxes today on the money that you've contributed to your Roth IRA. Now the difference is, if you think that your income taxes are lower today than they will be in retirement, and usually people talk about 59.5 because that's when the traditional IRA, you can start taking withdrawals from it. If your taxes are lower today, then you probably want the Roth IRA because you pay lower taxes now versus potentially higher taxes when you're 60. If you think your taxes will be higher, then you want to go to traditional IRA. Now, outside of the tax-deferred differences, the biggest difference also is that with your traditional IRA, you can start taking distributions at 59.5, but you must take them once you hit the age of 70. And that probably has to do with the IRS, or rather the U.S. government, wanting their tax money. There is no similar requirement with Roth IRAs because you've already paid the tax. Whether you get it now, at 59.5 or 65 or 70 or never, really is immaterial because the government doesn't get anything out of it. Now, other than that, the Roth IRA, you're always able to take out your principal contributions tax-free because you've already paid taxes on it. However, with a traditional IRA, you'll be penalized an additional 10% on top of taxes. So if you were to take a $1,000 distribution before the age of 59.5 and it's not a qualified distribution, then you would pay your income tax plus an additional 10% penalty because it's an unqualified distribution. Now, there are exceptions, and they're called qualified distributions. Usually have to do with hardship. There's one for first-time home buyers, and other than those, you can't really get access to your money without taking that 10% penalty. Now, other than that, there are some exceptions to the tax-deferred status of your contributions to traditional IRAs. It has to do with income. It has to do whether you have access to a tax-deferred retirement account otherwise, like a 401k or something like that. With a Roth, there are income limits to who can contribute to a Roth IRA. And that'll vary from year to year. But typically, in 2009, you will be able to contribute as a single individual if you are not within those cases of being in a phase-out region, $5,000 a year. So in 2009 it's $5,000, in 2010 it's $5,000. If you're over the age of 50, you get an additional $1,000 on top of that. So you can contribute $6,000 last year, 2009, 2010. Now, we're in this period between January 1st and April 15th where you can contribute to either 2009 or 2010. So if you do send in a contribution, be sure to note somewhere on the check with the letter that you want to contribute to either 2009 or 2010. Because what will happen is a broker, your IRA broker, will automatically assume because it's calendar year 2010 that you're contributing to 2010. So if you're giving a contribution for 2009, you want to write that on the check. And you have until April 15th to fund that account and still have it qualify for 2009. So I hope this video was helpful. If you have any questions, comments, please leave them in the comments. I'd love to hear them. Thanks and have a great day. Bye.